If you've got an HSA account, chances are that you are not using that HSA to its fullest value. And you could be making one of a number of mistakes with your HSA account. So in this video, I'm going to cover what I find are the top 5 mistakes that I see many people making with their HSA accounts that's costing them valuable money and growth on their HSA funds. Welcome back. This is episode 252. It's been a while since I've talked about health savings accounts or HSA accounts, and from conducting my semi-annual review meetings with clients and looking at different outside investments that clients have, I'm still seeing a number of mistakes that people are making with their HSA accounts. So in this week's episode, I want to go over what I think are the top 5 mistakes that people are making with their HSA accounts that's really costing them money with these HSA accounts and also preventing them from getting the most out of those accounts. But before I get into that, I just want to remind everyone that my online retirement planning course is available. It's been a little while since I talked about it, but I have a course where you can go through a series of videos and lessons to learn about how to plan your retirement. It's on the Retire with Ryan website. It's the Retirement Readiness Review on-demand course. So if you don't have a plan for retirement, or you want to learn more about Social Security, about Medicare, about investing, about estate planning, and really come up with an overall financial plan for yourself, then consider signing up for my course. Additionally, I also talk about taxes and much more. So if you head over to retirewithryan.com/on-demand, or you can click on courses and then click on Retirement Readiness Review on Demand, and you can sign up for the course. So if you're not familiar, what is a health savings account or HSA account? Well, they've been around for a while, but if you find yourself on a high deductible health plan, then most likely you are eligible for a health savings account. So this is an account that both you and or your employer can contribute to. And why I talk about it, and why I'm talking about it again, is that it's considered the only triple tax-free account that exists. What does that mean? Well, that means that you get a tax deduction on the contributions that you make in the account. You can invest the money and it can grow, and that growth and any earnings on that money or dividends or interest is tax deferred. And then if you take it out for health-related costs and they qualify, because there are certain health-related costs that qualify, there are some that aren't, but that will also be tax-free. So every other type of account that you could get tax deferred growth on, such as a 401k, an IRA, a Roth IRA, you're not getting a triple tax-free benefit. If it's a pre-tax 401k, you do get a tax deduction when the money goes in and it grows tax deferred, but when it comes out, you pay tax on it. If it's a Roth account, you do have to pay tax first on the money, and then it grows tax deferred and then comes out tax-free, but it's not triple tax-free. So that's why it's such a good idea that if you're eligible for one of these accounts, that you be contributing to it and possibly even maximizing that account. So let me talk about some of the mistakes that I see people making with their HSA account. So mistake number 1 is not having your money with a good HSA provider. So what's a good HSA provider? That would be a company that's administering your health savings account, and I would define them as good if they have a number of investment choices, some of them being low-cost index funds, whether that be stock index funds or bond index funds, something like the S&P 500. If we're talking about stock funds, the total stock market index fund. If they have a number of those and they have low cost, they should be less than 0.1%, and that would be a good provider. If they have a limited number of choices or all the choices are expensive mutual funds, because most HSA accounts do only offer mutual funds, then that's not a very good provider. Also, what do they pay on the money that's just sitting in cash or in money market? Are they paying anything on that? If they're not a good provider. Do they charge you money if you invest the money? Is there an annual account fee, a trading fee? That would not be a good provider. Also, how easy is their website to use? How easy is it to get your money? So there are a number of providers that don't really provide the things I've talked about. They don't have good investment choices. They don't pay on your cash. The website's not easy to use. So because of that, you might not know, but you can transfer your money to another HSA provider. There's a report every year that is done as far as what are the top HSA providers, and Fidelity, Charles Schwab are consistently at the top of that list. So if you don't have your account with one of those providers, you could transfer it over. You could do a tax-free transfer from your current HSA provider over to one of those other ones. And in the instance of those companies, they would pay you more on your cash. They have good investment options. Most of them, I believe, neither of those charge to have your account there. So it's a good thing to look at. Now, many people do have an HSA through their employer. So your employer is the one who's choosing the company that you're stuck with. Or at least maybe you think you're stuck with them, but you're not. You actually have the ability to transfer that over to another provider. Even if you're still working for the company, you have the ability to do a tax-free transfer of your HSA funds from that company to another. So if you were with a company that was not very good, you wanted to transfer it over to Fidelity, you could transfer it over, and that would be a tax-free transfer. You would just first set up an account at Fidelity, and then you would transfer your existing money over. You could continue to contribute to your HSA account through payroll deductions, and every so often you could transfer the money over. But rather than leaving it with a lousy provider, you could consider transferring it over to another provider. So that's mistake number one, leaving your money with a bad provider. Mistake number two is not investing your money. You'd be surprised, but I meet with a number of clients and prospective clients who have HSA accounts and their money is just sitting there. Some of them, it's sitting there not earning any interest at all, and that's terrible. So if it's not earning anything, at least look to see, is there a cash alternative, a money market fund, a short-term bond fund that you could put your money in where it will earn hopefully 3 to 4%, because that's what current money market funds are paying. So at a minimum, get your money invested so it's earning interest. You'd be surprised how many people are not doing that. Then secondly, consider coming up with a strategy to bucket your money. Well, what do I mean by that? Putting your money into two buckets. One bucket being the short-term money, the other bucket being their long-term money. And the short-term money, as I mentioned, should be earning a 3 to 4% interest credit per year, at least right now, because that's where interest rates are. The long-term money, probably you want to have it mostly in stock funds so that can be the growth money, because you're never, as your HSA balance grows, you're never going to need all of the money in 1 year. Remember, you're on a high deductible health plan. Yes, it's a high deductible, but there's a deductible. So whatever that deductible is, if it's $4,000, $5,000, $6,000, that's probably what you should keep in the short-term bucket. So that will be your short-term money. The long-term money, that should probably be invested in stock funds so that it can grow over time. Because the real benefit, as I mentioned, is the tax-free benefit of the HSA account. And to get the most of that, you want the amount that you put into the account to grow so that hopefully over time your contributions will grow and you're just spending your earnings of the contributions. You're not taking out your principal. So if you don't have the money invested, think about using a bucketing strategy. You can, use a mixture of funds, some stock funds if you want it more aggressive, some stock and bond funds. And then for your short-term money, you should be having that invested in at least a money market or short-term bond fund so that you can get some interest on that. So mistake number 3 is not contributing the maximum to your HSA account. Because these accounts are triple tax-free, I think that people that can afford it should try to put the maximum contribution into these accounts to take advantage of this triple tax-free benefit. So what are the contribution limits? Well, if you're a single person, the contribution for 2025 is $4,300. And that is between what you put in and what your employer puts in. So if your employer puts in $1,000 a year, then you could put in an additional $3,300. And then if you're considered a family for HSA purposes, and that would just be you and your spouse or you and any dependent, there's a higher limit. It's $8,550. So you can put that's the maximum, again, between what you and your employer can put into the plan. So if you can, try to max out what you're putting in these plans. Even if you cut back a little bit on your 401k, not below, don't ever cut back below what the minimum is to get the employer match. So if you have to put in 6% to get the full company match, make sure you're doing that. But if you're putting in 10% maybe you should back that down a little bit and put the difference into the HSA so that you can max out your HSA. And then if you're over 55 years old, you're allowed to make an additional $1,000 catch-up contribution into your HSA account. So that's could allow you to max out the plan. And then where people I see make a mistake with this is that if you're married, both you and your spouse can put, and you're both over 55, both you and your spouse can put that extra $1,000 catch-up in. So in order to do that, however, the spouse that doesn't have the HSA plan would need their own HSA account. So this is where opening an account with someone like Schwab, Fidelity for your HSA would be a great option so that you can put the $1,000 max contribution in there. Now, you might be thinking, well, do all these contributions have to go through payroll contributions? No, they don't. You have up until the tax filing deadline for that year. So in 2025, our tax filing deadline is April 15th of 2026. So if you find that at the end of 2025, you haven't put the maximum into your HSA account, you can make that contribution. Just make sure that you note it on your taxes so you take that deduction. And to make that contribution, you need to set up an HSA account somewhere else. Again, with Fidelity, one of the other good providers, and that way you put the contribution in. So mistake number 4 is treating your HSA account like a credit card rather than one of the best ways to save for retirement. So what do I mean by that? Well, many people that put money into an HSA, they take it right out. They don't invest the money. They're not benefiting from the compounding effect that you could get in your HSA account. So rather than do that, try not to pay those out-of-pocket expenses that you have for your health plan from your HSA account. Rather, what I'd like to see you do is pay those expenses out of pocket and then keep a record of those receipts, because that will get you the power of compounding. And then what you can do is you can reimburse yourself for those expenses at any point in the future. So any expenses you've had since you've qualified for an HSA account, you can reimburse yourself tax-free at any point in the future. So that's why it's a good idea to keep track of your expenses so that you have a record of what you spent. Because if you don't have a record of what you spent, then you're not going to know how much you could pull out tax-free. So again, the reimbursement of these expenses to yourself is a tax-free benefit. So you can contribute to an HSA all the way up until you go on Medicare. So once you and your spouse go on Medicare, then you can no longer contribute to an HSA account. So for most people, that's 65, because a lot of people do go on Medicare when they can, which is at age 65. And Medicare, once you go on Medicare, there's a 6-month backdating that happens for Medicare Part A. So that means that you have to stop your HSA account contributions 6 months before that, or you have to pay a 6% excise tax penalty on any contributions that were put in during that 6 months prior to when you enroll in Medicare Part A. So you want to stop that 6 months before you enroll in Medicare. Stop HSA contributions, that is. So because you can reimburse yourself at any point tax-free, it's a really good idea to try to get the power of compounding. Or there are some things that maybe you don't realize you can reimburse yourself for, such as long-term care insurance. If you find yourself on COBRA health insurance, so that's health insurance that if you leave your job or get laid off, you're paying for that. That can be paid out of your HSA account, and you can reimburse yourself for those costs. If you're on unemployment insurance with your state, I believe that can also be used to pay for health insurance, but you can't use your HSA account to pay for private health insurance or Medigap. So those are expenses that are not eligible. However, once you turn 65, you can pay for Medicare Part B and Part D and Medicare Advantage from an HSA account. So those are expenses that you can reimburse yourself with. Because if you're thinking about Medicare Part B, how do you pay from that from your HSA account? Well, normally with Medicare, once you go on Social Security, your Medicare Part B premium is being deducted before you get your Social Security payment each month. So you couldn't technically pay for it from your HSA account, but you could take the money out and reimburse yourself. Also, if you're married, and let's just say you have the HSA account and your spouse doesn't, you can reimburse yourself for your spouse's Medicare Part B premium as well. So there are a lot of things that you can pay for from your health savings account, even when you retire. And it could be a way to bring in tax-free money to yourself, because the Medicare Part B premium is $185 a month right now. And so that's just the minimum. You might be paying more. So if you have an HSA account and you want to take out money tax-free to go on a trip or pay for whatever, you can do that from your HSA account. That's an eligible expense once you turn 65. So it's a good idea, to make sure that you are tracking, these expenses. And that leads me to my fifth mistake that I see people making, and that is not tracking expenses. So you should be tracking your expenses. And how do I suggest you do that? Well, I would keep your receipts for any out-of-pocket costs that you've had that would qualify for your HSA account for reimbursement. And you could scan them or keep them in a file just in case you get audited. Because if you get audited by the IRS and they say that you don't have these receipts, then you're going to have to produce them. And if you can't, then they might say these were not HSA qualified expenses. So tracking your expenses and keeping receipts is very important. And additionally, you should keep some type of Excel file or Word doc with your expenses. So this is what I do for my family. Unfortunately, I'm no longer eligible for a health savings account. My wife's employer does not offer a high deductible health fund, which is good because we're paying a little bit less in premium. But I had an HSA account for years. And so I have an Excel file that ever since I was on the HSA account, I do my best to track any expenses that we pay out of pocket. So it says, okay, $50 that I paid to go see the doctor, or $80 for a prescription, or whatever I've spent, I keep that file, and I also save the receipts. I scan the receipts, I save them in a file, and then I know what I've paid so far since I've had the HSA account. So at any point, I can reimburse myself for these expenses tax-free. I'm not doing that for a while because I'm 46. Hopefully, I can work until I'm 65 and then go on Medicare. So at that point, then I'll be looking to start taking the money out of the HSA account and reimbursing myself. So I'll be getting the power of that compounding growth, and then I can use that money later on in retirement for tax-free income. Or if I don't have enough expenses, and I've reimbursed myself for everything, then I can always, as a backup, anybody can just take money out of an HSA account and you just pay taxes on it. So if you wait until you're 65, there is no penalty to take out money from your HSA account for non-health related costs. So it really functions just like a 401k. So that's why it's such a good idea to make sure you're maximizing what you put into this account and investing it and getting it to grow, because of the fact that it can be just like another 401k if you don't have any health related expenses. So make sure you're not making mistake number 5. You're tracking your expenses, you're keeping your receipts, keeping good records, so that at some point you can reimburse yourself for any expenses that you've paid out of pocket, or any future expenses that you have, like Medicare expenses when you become eligible for Medicare. So I hope this episode was helpful and gives you some ideas of the biggest mistakes people are making with their HSA account, and take action on these mistakes. Make sure that you're not making these. And if you have a listener question you want to have considered for a future episode, you can leave it by heading over to retirewithryan.com and clicking on Ask a Question. Hope you have a great week, and I look forward to talking to you next Tuesday. Take care.